There we go, to confirm that. Right. Tracy, can we just have a look at our agenda, please? Right, so Ian is going to go through the key changes to start with. Then we're going to be looking at inheritance tax planning considerations and strategies. Then we're going to be thinking about using pension savings to enhance inheritance tax planning and using the ultimate savings plan. More a bit later. Then Felicity is going to give us an economic and market update overview from Felicity's from Vanguard. Then we're going to be looking at what might be coming next as far as future budgets are concerned, and then just reviewing some of the key takeaways and action points from today. I might be talking quite quickly, so I apologise if I am. You'll always have a link to watch this afterwards if you'd like to enjoy it again. I'm going to hand over to Ian now, who's just going to run through the key changes. Over to you, Ian.
Well, good morning, everybody. Thank you, Katie. Hope the sun's shining where you are. You can see my sunflowers in the background. I'd like to say they're real, but they're not. So I'm actually in a bit of a false kitchen here, but I thought I'd leave the sunflowers in. So just in terms of the overview of the key changes following the spring statement, then I think it's probably fair to say that there were no tax rises announced in this spring statement, but the damage was done in the last autumn budget. And you can see the consequences from some of the headlines that appeared pretty soon after and continue to appear, that it does look like, dare I say it, the pensioner population and those of wealth are at risk of a further tax raid at some point coming down the line. And that's from the Institute of Fiscal Studies. So savers alone are threatened with some tax increases. Katie will touch on that a little bit later, but it does look like the autumn budget was the one that did the damage. So within that was the key change was around national insurance contributions. They've increased quite significantly for companies, and those costs are going to end up getting passed on to us as consumers. One of the obvious areas that has really been hit quite hard is the care home sector, so that's likely to have implications in terms of care costs. Private schools lose their eligibility as well as charitable status, so those costs are likely to go up. So that was the big one. Stamp duty is well reduced quite significantly, so the costs of owning or buying a new home have gone up quite a lot by that threshold, reducing by a half. Costs for owning holiday homes have also gone up. So if people have a second home, they're likely to be hit quite hard with new council tax increases. You've probably seen the headlines on those as well. Now, personal rate savings allowances were quite impacted in the last budget, and they've now reduced quite significantly down to £1,000 for a basic tax rate payer and £500 for a higher rate taxpayer. CGT was left alone in the last budget, so it remains unchanged at 3,000. But I'm sure most of us here can remember it wasn't that long ago that that threshold was over £12,000. So that again was left unchanged, but still quite low. And the personal allowance is now frozen yet again at 12,570 for basic rate taxpayers. That will actually have an impact of bringing a lot more people into the payment of tax as a consequence of the state pension increasing that takes effect this month. So now all of those have been offset, if we listen to Rachel Reeves and co, by the fact that the state pension has gone up, the minimum wage has also gone up. But alongside all of that, we've all seen quite significant increases this month again in the energy cap has gone up. Council tax, I don't know if you've seen your council tax bills, but mine I know has gone up quite significantly. My water rates have gone up. Car tax also goes up this month. Broadband and mobile phone charges are increasing. Food inflation is still running quite high. So the upshot of all of this is that most people are starting to feel a little bit worse off. Bit of a doom and gloom situation. I apologise for that, but I mean, that is the reality. So if I hand you back over to Katie, and Katie will talk through specifically around some areas around inheritance tax as well. So over to you, please, Katie.
Unmute. Thank you, Ian. Right, so inheritance tax planning considerations and strategies. So just have a quick refresher on where we are now. The nil rate band is currently £325,000. That's what we can pass on to loved ones free of inheritance tax. In addition, we have the residence nil rate band for those who are ultimately passing on the value of a property to children. But we need to watch out, because when an estate is £2 million in value, we start to lose the residence nil rate band, £1 for every £2 over 2 million, which means for a couple, if the estate has gone beyond 2.7 million in value, we've completely lost that residence nil rate band element, and we're down to just two lots of £325,000 as the maximum tax-free amount we can pass on. Thresholds are frozen until at least tax year 29/30 in relation to nil rate band and resident nil rate band. That was actually something the Conservative government brought in before they disappeared. And of course, now we've got the possible extension of that freeze on those thresholds going forwards. That'll be more than 20 years with the same thresholds. So it's quite clear that many more estates are now being caught by inheritance tax. We're anticipating around £8.4 billion inheritance tax take for the tax year 2024-25, up from £7.6 billion last year. So inheritance tax is certainly plugging a few holes for our good friend Rachel. So what are some of the strategies for reducing inheritance tax? Making gifts, gifts of capital and living for 7 years. That's always a good way of removing value from an estate. We need to be very careful when we're passing gifts through trust and making outright gifts. So the difference between chargeable lifetime transfers and potentially exempt transfers, because the two don't mix very well when it comes to inheritance tax planning. And if you're thinking of making gifts, then please do come and talk to us and we'll talk you through that aspect. One of the things that many people get confused about is taper relief on gifts. People assume that if they make a gift, then there will be a reducing amount of inheritance tax applicable over the 7 years. Just to clarify, that only applies to gifting in excess of £325,000. So if you made a gift last year of £250,000 to your children, that full £250,000 remains within your estate for the full 7 years before being outside for inheritance tax purposes. We often talk to our clients about inheritance tax exemptions. Making gifts out of regular income that don't reduce your standard of living is a popular way of making additional inheritance tax planning. For example, passing regular gifts to cover school fees or music lessons or our children's pension investments and mortgage payments. They're all good ways of supporting the family by making gifts out of regular income. However, careful planning is needed. Please talk to us if you feel that's something you want to incorporate, because we certainly feel that it needs to be documented carefully. But it's a great way to slow down the increase in an estate value if there is disposable income at the end of every month. Don't forget that annual exemption allowance. We can all give away £3,000 a year, and we can make some small gifts as well. And if you want the full list of exemptions, please do ask. Leaving gifts to charity or your own charitable estate in your will. Well, if you leave 10% of your net estate to charity or your own charitable trust, then the rest of your taxable estate benefits in a reduction in inheritance tax from 40% to 36%. Some of our clients like to use that. You can also move capital gains tax heavy portfolios into charitable trusts or make gifts to charities and avoid that tax being paid. Next slide, please, Tracy. So I just want to touch on investment bonds again. We did cover this subject in our last webinar briefing, but I think it's important just to refresh our minds as to what these are, because they help with the inheritance tax planning ultimately. So what is an investment bond? An investment bond is a single premium investment that's divided into multiple segments. Through an investment bond, you can access all of our Montgomery multi-asset funds. They allow you to take up to 5% per annum withdrawals without any income tax complications, and that 5% is cumulative. So if you didn't take it last year, you're not taking it this year, and you want to take some next year, you can take up to 15% of your original investment out, free of any income tax implications. There's no capital gains tax on the growth in an investment bond, although tax is settled within the funds. You can gift those segments out to other family members for them to cash. And obviously it comes under their own income tax situation if you do that rather than yours. If you're a couple with an investment bond, you can transfer it to a lower tax rate spouse before encashing it to benefit from the most favourable terms when you're taking capital out or encashing the investment. You can put an investment bond into trust or some of the segments into trust. So it's really helpful from an inheritance tax planning, if not today, in the future. And the investment then can go on beyond death if your beneficiaries would rather that it just continued. I think investment bonds are ideal for couples who want to set it up on a joint life basis for the continuation of regular withdrawals after the first has passed away. It's also ideal for those who would otherwise have capital gains tax planning issues by investing in general investment accounts, unit trusts, and shares. We have a document that covers all the benefits, the advantages of using capital investment bonds, which we will send out to everybody after our webinar. So coming back to pension changes, just want to give you an update on the post-autumn budget pension announcement. So the autumn budget identified that from April 2027, pensions are going to be included in the estate value, added to everything else when calculating inheritance tax. Until April 2027, they are outside of the estate value. For many of our clients and their family members, the inclusion of a pension pot value plus the value of a property risks the estate exceeding that £2 million very quickly and then losing that residence nil rate ban. So that's something to watch going forwards. As we mentioned in the last briefing, that consultation is underway regarding this particular change, consultation on the reporting, the liability and the payment of inheritance tax, but we still don't have any categoric feedback yet. We'll let you know when we do. We feel that the sticky issues or the unintended consequences of this are, who's responsible for reporting on and paying the inheritance tax on a pension? Well, we know that's going to be the pension scheme administrator, and for many of our clients that means Transact. But who gives them the figure that they need to pay? Well, it's going to be our personal representatives. Our executors are going to be responsible for identifying what the apportioned inheritance tax will be in relation to the pension. So just to remind our clients and their families, within our legacy protection business, we have a probate service, and I think that's going to be essential for lots of our clients going forwards. Ask us if you would like any more details about that. For those of our clients who have asset preservation trusts set up around their pension investment and their death in service benefits, then the recommendation from us and our legal partners is that we just carry on as we are. They still continue to be beneficial, but we will be planning to make alterations to the letter of wishes that sits alongside these trusts in the first quarter of 2027. So just watch this space. Our legal team are talking about the possibility of introducing a joint asset preservation trust for couples with pension benefits, because these might actually be more beneficial going forwards. So how can we use our pensions to enhance inheritance tax planning? So if we were intending to leave our pension pots to children, we know that these are going to be taxed at 40% after April 2027. So it means that we might want to start using our pension now to do some effective inheritance tax planning. What are the options? Well, firstly, taking tax-free cash out. This might be something that Rachel attacks in future budgets, the opportunity to access tax-free cash from pensions. So it seems like potentially a good way forward, and using that tax-free cash to make gifts into investment bonds in trust, live for 7 years, and then we've effectively removed the tax-free cash element from the estate again for inheritance tax purposes. Investing into discounted gift trusts. It's an investment bond wrapped in a discounted gift trust. That gives access to regular withdrawals from an investment, but it benefits us by giving an immediate discount for inheritance tax purposes. Taking increased income from pension, that allows us to potentially make more gifts out of regular income that don't reduce our standard of living, or using income from discounted gift trusts or pension funds to fund joint life, second death, whole of life insurance, or single life, whole of life insurance. Bit of a mouthful, sorry. We call this the ultimate savings plan. So as mentioned, these are known as whole of life plans, joint life, second death, or single life. And the advantages of these are they're written in trust to keep the life insurance benefits outside of the estate for inheritance tax purposes. They give significant liquidity because they pay out in advance of the grant of probate being received, so might prevent the need to sell assets in order to pay the inheritance tax liability. They can also be extremely cost effective, and I'll show you in a minute what that looks like, but premiums for couples generally are lower than two individual whole of life insurance policies because the payout occurs after both policyholders have passed away. It gives some certainty and ensures a guaranteed payout for our loved ones, which offers peace of mind about the payment of that inheritance tax liability. And I'm going to give you some examples. Just literally some figures pulled off our system first thing this morning, just to take you through these. Apologies for this slide that looks a bit confusing, but I just talk you through it. So £500,000 worth of joint life, second death life insurance for a couple with male aged 75, female aged 70 is £946 per month. You would need to live, or one of the couple would need to live for more than 44 years before the amount paid out, tax-free, if written in trust, exceeds the premiums paid. Interestingly, an investment of £325,000, if you're taking a 3.5% income from that, that would cover all of the premiums going forwards. And plus the investment, if written in trust, is another pot that's added to the life cover to help the family pay the inheritance tax liability. £250,000 worth of cover for a male or female age 75 on a single life basis costs £869 per month. So you can see that, you know, that's a big premium compared to the joint life premium. But a 75-year-old would still need to live for more than 24 years before the premiums paid equaled the amount paid tax-free from the whole of life insurance. An investment of under £300,000, if you're taking a 3.5% income withdrawal from it, that would fund the premiums for the rest of your life. It's also important to say with these figures that these are assuming standard rates, so assuming that there's no medical underwriting that would rate the premium and make it higher. However, you know, we've had in the last year, we've had a couple of cases where clients have been medically rated, but it has still worked out at being the ultimate savings plan, a very good thing to do for the family. So that last scenario, though, is a real life case that we quoted for clients last week. £500,000 worth of joint life second death cover for a male age 68, female age 67. The premium is £772 per month. They would need to live, one of them would need to live for more than 54 years from taking the policy out before the premiums paid exceed the amount of benefit paid out to their family. So in this particular case, they need £265,000 invested, taking an income withdrawal of 3.5% to cover all of that premium for the rest of their lives. So that's why we call it the ultimate savings policy. For that particular couple, it's really important to them that 2 of their 3 children have the opportunity to continue living in the family home beyond second death. And so, that's why that they want to make sure they've got some solid cover there in place. So apologies for all the numbers there and the detail. Very happy to talk to you about that if you feel it's something you'd like to look at. Next slide, please, Tracy. Right, I am very pleased now to be handing over to Felicity, who's going to give us an economic market update. Over to you, Felicity.
Thank you. Katie, before I start, can I just check if you still want to finish at 11 today?
Oh, Katie's on mute, but I think reflects.
Sorry, Felicity. 11:15. End date.
11:15. Oh, okay, great, perfect. All right. Well, very nice to meet you. Thank you so much for having us. I'm Felicity, and this is Imogen.
Yes, I'm part of the team at Vanguard that look after financial advisors. So we support Montgomery, and then of course your underlying yourselves as well.
And I work in the investment team, and I've been in banking and investment management for 18 years, doing various roles with interest rates, inflation products, institutional clients and retail clients. And basically I work with clients to analyse their funds and to provide them with a sense of how Vanguard see the world in terms of our economic and market outlook, which is what we're doing today. So the plan for this session for the next 15 minutes is to share with you how Vanguard see the world and talk you through what's happened in the last couple of months, so year to date, what's happened in markets, go through some of the questions about why that's happened, what next for markets, and so what. So what does that mean for you? So Tracy, thank you so much. We'll stay on this slide for a bit if that's okay, because basically that's quite a hard thing to do at the moment. Already this year we've seen fragile economic data, very, very volatile geopolitics, and some real policy surprises, and that's led to some big unpredictable swings in markets this year. And I also wanted to just acknowledge that it's been a tricky few years for investors, particularly if they're in that decumulation stage. So if you're already thinking about taking money out, or if you're in lower risk investments, it has been a really, really hard few years for you, but there are reasons for optimism going forward, and that's where we're going to try and finish today. Now, as I said, it's a very difficult market environment to navigate at the moment, and a lot of professional active managers have been losing money by trying to second guess markets. What that means for you is actually it's a really good thing that you're with Montgomery, because Ian was explaining the approach he takes with your investments. You're largely in multi-asset funds, and that gives you an inherent discipline in your investment approach, and it takes the emotion out of your investment decisions, which is a great thing when markets are quite scary. It means that you can ignore the noise. This disciplined approach means that when things are cheap, you can buy low and sell high when they're expensive. And the more unpredictable things get, the more important it is for you to stay the course, stay very diversified, and we say don't make any sudden movements. So hopefully that gives you a little bit of confidence in what Montgomery and the team are doing for you. And this is just a chart to show how various asset classes have performed year to date. But if we wind the clock back a little bit, over 2024, it was a very, very good year for equities, for risky assets. And for bonds, it was a little bit mixed. And the reason for that is basically that inflation proved a little bit more sticky than everyone had expected, and central banks weren't able to cut rates as quickly as expected. And at the end of last year, the US looked like it was doing really, really well. They had momentum that seemed fairly unstoppable, even though valuations looked really, really expensive. You'll probably have heard of the Magnificent Seven, these tech stocks that had extremely strong valuations. Whereas on the other hand, Europe seemed very fragile. And 2025, you can see from my chart, has been a year of surprises. There are things that have happened that were not priced into markets, both good and bad. And I'm going to focus on 3 things today. Firstly, the new German government and what they've done, Donald Trump and his tariffs particularly, and then also some data that suggests that inflation may still not quite have completely left us. So the chart, the thing you'll probably notice first is that equity number that we see Europe up really strongly this year. And the reason really for that is what people are calling the German fiscal bazooka. So this plan to spend an awful lot more, including on defence. And that's very, very positive for German stocks, that kind of expansionary policy. It's been negative for German bond, but very, very mildly, unlike, you'll remember the Liz Truss mini budget and that market panic, as which was about unfunded tax cuts rather than increased spending. But within Europe, the UK has actually rebounded strongly so far this year after a weak 2024. And some of last year's underperformers have also come back very strongly, like emerging markets you can see on the chart, and China within that as well. The other thing you'll probably notice is gold, that strong return so far this year. And gold's already at record highs. That's largely investors reacting to higher geopolitical risk and the ongoing global conflicts, as well as concerns about inflation coming back. And then the other things that you'll notice are the US now down. And I think basically Trump 2.0 wasn't really priced in by markets. It's to be very fair to Donald Trump, it looks like there's a higher likelihood of the Ukraine conflict coming to an end in one shape or form. But I mean, tariffs have been the big thing. And obviously today is what he's calling Liberation Day, and what the rest of us are calling, oh no, what's he done now day. And Trump so far has been surprisingly tolerant of negative market reactions. So if we go on to the next page, Tracy, thank you. I'll just say very, very, very briefly that this is a real change for Germany. Germany under Angela Merkel has been very fiscally responsible, very, very careful. And this is a big change, very expansionary. They want to spend on infrastructure, on industry and defence. And I can't overstate how much of a game changer this is for Europe and how much it took markets by surprise. And on the next page, please, Tracy, we see that feeds right in to more optimism for Europe. And going forward, our economists really expect growth to revive. That's probably, again, good for equities, maybe not quite so good for their bonds. And if there is a potential ceasefire in Ukraine, we think that would lead to lower energy prices, more confidence. They'll be spending to build back in Ukraine. So even a very fragile ceasefire, we think, is positive for the growth prospects in Europe. And then could we go on to the next page, please, Tracy? However, this good news story for Europe could be completely rewritten by tariffs. And you will have seen the headlines on tariffs. The big question today is whether Trump is going to actually impose reciprocal tariffs. It is incredibly difficult to predict not just what Trump will say, but what he'll actually do. He's talked about 25%, and markets have really reacted to that. Will it actually be 25%, or long-term will tariffs settle at more like 10%? It's very, very hard to say. But that uncertainty has led some companies to really hold back on investment. For other companies, manufacturers, to front-run their manufacturing. If we go on to the next page, Tracy, this is really just showing that different countries and different sectors within those countries are going to be affected very differently from tariffs. And this is just a quick glance to show you, with the big bars, are those countries which are most at risk from Trump's tariffs. And then on the next page, we see that tariffs don't just hurt the US as trading partners, they actually hurt the US itself. And since the start of the year, our economists think the risk of a recession in the US has become much more likely. The uncertainty we have around Trump was already causing companies to hold back. It's already restricting growth. And we think that there could be a real impact on growth. In the first quarter this year, we think the US economy has probably contracted, and there's a higher risk of a technical recession. And if we go on to the next page, please. This has really taken markets by surprise. I think when Trump was elected, it was very tempting to look at last time round and think, oh, well, Trump was decently good for markets. This time will probably be the same. Trump doesn't want to annoy his own supporters. If markets fall sharply, he'll probably reverse course. But actually, he's approached his second presidency very differently so far. He's much less inclined to work with the rest of the Republican Party, and he's much more inclined to just do his own thing. And what's that meant for markets? So the Magnificent Seven is probably another thing that you've heard a lot about, these big tech stocks. If we go on to the next page, I think this is probably what clients were asking us most about last year. They were saying, these stocks are so expensive. Is there going to be some kind of correction? And I wanted to show you this just to make the fairly broad point that we don't think it looks like a completely irrational bubble, because behind these high stock prices for companies like Google, Amazon, Facebook, Apple, Microsoft, Nvidia, they are very, very profitable, and their earnings are very strong. So whilst they look expensive, it's not entirely unsupported by reality. And so I know that's been a real high-level kind of whistle-stop tour around the world. There's a whole section that we took out, isn't there, Ian, on inflation data in China. But I wanted to just sum up by asking, well, what does this mean for markets going forward? So, Tracy, if we could skip ahead one more, please. Thank you. Oh, yes, thank you. Perfect. And the big answer is we have absolutely no idea. It is impossible to tell at this moment in the short term what is going to happen in markets. It's always impossible. I mean, that's what Vanguard believe. It's always impossible to predict short-term market movements. But at the moment, I think we would say that uncertainty is unusually high. It's unusually difficult to have a strong conviction of markets going either way. But one good thing is that this chart is showing the relationship between equities and bonds. And so equities are the risky bit of your portfolio. Bonds we hold because we think they're the safer part. And under normal conditions, they are negatively correlated. So they're in this shaded part of the chart. And that means when equities go up, bonds might go down. But when equities go down, crucially, like they did in COVID, bonds go up and they dampen some of those losses. So that inverse relationship is really important, that one goes up and one goes down. And you can see on my chart that for the last couple of years, they've actually more been moving together. And the reason for that is that some factors like inflation are kind of bad for both, and that some of the drivers for them are the same, like very, very high central bank interest rates are bad for bonds, but also make it more expensive for companies. So what we've had over the last couple of years is this really troubling correlation between equities and bonds. So when I mentioned low risk decumulation kind of portfolios, that's the kind of trouble that you've been through in the last few years. But what is positive and reason for encouragement is that we've now dipped back into the bottom half of that chart. Bonds and equities are more behaving like we want them to. And so to the extent that we do have recessions or drawdowns in the US or in other sectors that tariffs hurt, that's potentially bad for equities, but that's potentially good for bonds. And wonderfully, we seem to be back to slightly more normal chaos rather than the chaos of the last few years. And so what does that mean for you in your multi-asset portfolios that Katie and Ian are running? It's a good thing because it means that you get the benefit of that multi-asset approach and having automatic rebalancing, so that when one of them goes very high, like equities went very high last year, as equities went higher and higher, you would have been incrementally just selling and locking in those gains and buying bonds when they were very cheap. And then that's a very good thing for you to be buying the cheap thing and selling the expensive thing. And so, Tracy, if we go ahead one more, I wanted to show you this next slide. Sorry, Tracy, one more, please. Just to show you, really, the absolute chaos of trying to predict short-term returns. This is showing you which asset classes have done best over the last almost 10 years. And you can see that US equities, have been up there. But if you look too hard and try and discern a pattern, there really isn't one. It's really, really tricky to anticipate what's going to do well in any particular year. And so those of you that know Vanguard, you'll know that we very much have the approach of, therefore, you don't try, you just try and stay very consistent, very diversified. And I mentioned gold right at the start because of that return that's really rocketed. Gold, I thought gold was on this chart. It's not, but if it was, it would have bounced all the way around. It's incredibly volatile. And so that's an asset class that we don't put in because it really does make your portfolio swing all over the place. And so very, very, very difficult to pick out a single asset class that does consistently well over a short time period. But what we do think we can do is have a good guess at predicting long-term returns based on valuation. So if something looks cheap today, we think there's a good chance that over time it's going to come good. And again, what does that mean for you? Tracy, if we go ahead again, I'm just going to share with you. Oh, sorry, here is gold. Sorry. We'll go ahead again. What I'm just sharing with you here is what our economists forecast as equity returns over the next 10 years. So crucially, we're not saying for the UK equity, you can see this median expectation is 6.7. What we don't think is that equities would just bank 6.7 every year. We think it goes up and down, and obviously there's a lot of uncertainty. So we give you a bit of a distribution. But you can see generally that we think UK has had a couple of years of weakness and has scope to maybe pull back and do a little bit better, whereas the US, having done so well, we think it's very difficult to see a scenario where it continues. But overall, you can see our expectations for equity, and then separately on the next page, our expectations for bonds. Tracy, thank you very much. And I just wanted to draw your attention to this because as you've been investors for a long time, you'll have been used to seeing much lower numbers for this. We had a long time of bonds yielding almost nothing. And as I mentioned earlier, you've lived through a really tricky time in bonds that were supposed to be safe, having big drawdowns. The really good thing that has happened is that they are now giving attractive yields. So you've bought bonds at a good time, and they're now giving you this really healthy return of close to 5% a year. That gives you an awful lot of protection against bonds going up and down. And also, from this slightly lower base, we see bonds actually doing pretty well over the next 10 years, which is a really good thing for investors like you who are in those lower risk areas. And what does that mean when we put it all together? Tracy, could you just go on to the last slide? Thank you. That means that when you put those together, those blends actually start to look really powerful. And for me, having been in investments for nearly 20 years, it's really unusual that we see a set of returns like this, because at the left-hand side of the page, this is the lower risk portfolios. You can see that the median expected returns are almost the same as for the higher risk portfolios, and the uncertainty around them is a lot narrower. What does that mean for you? It means that by sitting tight, holding tight, staying the course, no sudden movements, we think that your outlook is actually much better going forward. It means a more stable, healthy retirement income for investors who are in this kind of low risk, diversified portfolio. So I hope that amid all the uncertainty there is in the world and all the kind of news that you see in the headlines, that gives you a little bit of confidence that what Montgomery and Vanguard and your other investment partners are doing for you is actually helpful in helping you reach your goals through all the market turbulence. And that's all I wanted to cover, Katie, and I hope that's all right.
Thank you, Felicity. That was extremely helpful, very interesting. I found it very interesting, and I hope our clients found that extremely reassuring as well. Thank you. So what's coming next? What might be coming down the line? We talked about some of these things in our last briefing, but just to go over them again, pensions, tax-free cash. Will Rachel go after that? I think there's a reasonable chance she might. The lifetime allowance on pension funds was removed by the Conservative government, but could easily be reintroduced. It was £1,073,100 when it was lifted, and any pension over that would ultimately be taxed at 55%. So I could imagine that coming back in and that tax rate possibly going up. Cash ISAs. Well, we've seen in the news recently that cash ISA limits may be seriously reduced, perhaps down to £4,000. That could be coming along. Dividend treatment, more taxation on dividends, yes, quite possibly. Capital gains tax allowance, well, there's hardly anything there now, but you know, the £3,000 that could go completely. Business relief changes, we know that there are some of those coming down the line anyway. And as Ian suggested, we're seeing council tax being re-rated, utility bills going up. So more of that, I'm sure, to come. wealth tax that's been rumoured on larger portfolios, that could be introduced too. But to reassure you, there's only 8 more Labour budgets to go. And we will be here with you for all of them. So thank you very much for joining us today. Oh, key takeaways. Let me just go through these. As we always say, it's important to review wills and trusts on a regular basis, particularly now undertaking new inheritance tax calculations, making sure that we're doing that on a regular basis is always important, particularly now we've got those pension funds coming into the equation as well from April 2027. As I said earlier, watching that £2 million threshold. So if there's anything we can do to avoid the loss of residence nil rate band, that we need to look at carefully. Every one of our clients and their family situations are different, and we recognise that, and we're here to support you and your families through these changes. And if you'd like to sit down and talk about anything we've covered today, please do contact us for a review. There are a few bits of information following this that we will be sending out to you just to cover off some of the subjects we've talked about. But if you've got any questions, you know where we are. Thank you for joining us today. And thank you again, Felicity and Imogen, for being with us.